everyone. I think we all know that this year has been eventful for markets. The first 2 months saw a decent correction, and then the last few months have been about markets trying to build in a recovery. And in that context, May 2 was an interesting month for markets as uncertainties appear to reduce on multiple fronts. Geopolitical risks subsided as India and Pakistan reached a ceasefire, thus averting a full-blown war. On trade, the much anticipated India-UK free trade agreement, it finally saw the light of day. And similarly, the US and China trade tensions also appeared to reduce as the two countries dialed down on hostilities. And in this environment, global markets did well for the month. And on a YTD basis, too, amidst a weakening dollar, emerging markets have done well along with precious metals. And against this backdrop, foreign portfolio investors, they continue to buy into Indian equities for the second month running. They obviously were aggressive sellers in second half of FY25. And as a result, Nifty and Sensex, both of them did well for the month. But I think the bigger story from May was that there was an improvement in market breadth after several months of deterioration. So BSE 500 outperformed the Nifty and the Sensex, mid and small caps outperformed BSE 500 and so on. And this came even amidst a pretty weak Q4 FY25 earnings print. So we saw profit growth in single digits. But the good news was that this was largely in line with expectations, and that helped arrest any incremental earnings downgrades in May. The consensus now expects somewhere close to just about double-digit earnings growth for FY26, and that will be a decent improvement from where we are today. But revival in India's economic growth and hence top line is critical for this expectation to be met. Now on economy, on one hand, monetary policy should help an improvement in the domestic economy. We think global policy uncertainty may mean only modest earnings growth on the other hand. Now on the domestic economy, I think RBI continues to be very aggressive and we think they've been aggressive on triple easing across rates, liquidity and regulation to boost growth. And with system liquidity comfortably in the surplus, significant easing in bond yields and more rate cuts going forward, we believe the stage is set for an improvement in credit growth and therefore a revival in the domestic economy. On exports, while the deal with UK is positive, hopefully we'll have a deal with US over the next few months and potentially EU at some point in the future. And these are all positive developments for India's market share in global exports, but I think the direction of export growth will remain dependent on the state of the global economy and global exports. And the external sector continues to be marred by policy uncertainty around tariffs. Prolonged uncertainty not only leads to near-term disruptions, but may also impact corporate capital expenditure intentions. In that context, when you think of Indian equity markets, two things have changed for the better over the last few months because of the correction. First, the sharp drop in 10-year bond yields over the past few months has meant that on our preferred gauge of equity valuations, that essentially looks at equity yields as a relative spread to government bond yields, equity valuations have now come back to averages and they stay near that even with the recent uptick. The second change is that on equity sentiment, as measured by a proprietary framework, sentiment has come in the neutral zone after the cool off from very stretched readings of the past year, thanks to the correction. Now, in this combination of average valuations and neutral sentiment has underpinned our neutral stance on equities for the past 3 months, and this was a very significant change from the underweight stance that we had carried for a good part of the last year, and that neutral stance stays. So versus expensive valuations and stretched sentiment last year, we are now back to neutral on both, and that has driven the neutral stance on equities. Finally, on portfolio positioning, we continue to believe that amidst an uncertain macro environment, market action will turn more stock specific now, with quality and long-term fundamentals being preferred versus the more or less indiscriminate nature of last year's rally. Until next time, thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.